I think most of the people that joining us are my clients. Thank you for being a loyal client of Zhou Agency. We really appreciate your business. So today we go a little bit deeper dive on bonus depreciation. And our first webinar talked about why real estate is the best investment under the tax code, not the best investment in terms of just the absolute return, but more from a tax perspective. You can save so much tax, so make the tax equivalent yield very attractive. So after that, we'll have a lot of people have questions about the bonus depreciation that we touched upon. So today is a deep dive. First, I want to introduce our guest speaker. They are definitely a dynamic duo. I always say that, Andy. So the duo is missing one right now, but Andy is here already. So Andy, please give us a little rap sheet.
Hi, good day, everyone. First off, my apologies that my wife, Dr. Githika Klivos, will not be able to join us. She had to take an unexpected trip back to India. And right now, due to the time change, she is otherwise unavailable. But no worries, I'll be able to share as much information and background, which I hope is useful for everyone. I'm Commander Dr. Andrew Klivos. I am my primary profession is in public health with the U.S. government. My wife is a physician, and together, in addition to our W-2 paying jobs, we have also started down our real estate investment path since 2020 and have worked on building up a portfolio initially focused on long-term rentals, but then due to the tax advantages you're about to learn much about here shortly, we pivoted our focus to short-term rentals or Airbnbs or VRBOs, anything that would be less than a 7-day average rental period for the average of a year. And that's what qualifies as a short-term rental. And so since we've started, we have built a portfolio since 2020 of 7 STRs or short-term rentals. And our goal is to acquire and have up to 15, which we believe is our kind of liberating point, if you will, for financial freedom. We don't want to call it retirement because, as you may also commiserate with, we like to be busy, but we want it to be on our terms, not on someone else's. And so this is really about, being able to liberate our time for us to focus on what we want to focus on. So thanks for the opportunity.
Thank you, Andy. The way I asked them, guys, when I did their tax return, I say you have, 2 full-time jobs. And as a physician, that job is very demanding. I know that. And then you have 2 kids. And then you have 7 or 8 properties, and they are all short-term rentals, and they self-manage them. So my question to them is, do you sleep, Andy?
we fit it in when and where we are able to.
But I really like the way you said you want to be busy because you want to be engaged, you want to make contributions, but on your term. That's the key, not being dragged around by some other employers or boss or whatever, right? Okay. All right, thank you so much, Andy. Let's go to a little bit my own company. I guess most people know we do tax, but we are not just doing tax. We are a firm that provide tax efficient strategies, a lot of times even to execute it for you. So we have a lot of different arms like real estate, like insurance, accounting, and tax. Let's get to what is bonus depreciation. Sounds very interesting because I believe if you ever hit that on the Google, this is the buzzword, right? And the bonus depreciation is the buzzword. So maybe I can ask you, when did you hear? You said in 2020 you started real estate, then you pivoted. When was the first time you heard of bonus depreciation as a doctor?
So yeah, the first time we heard about it was probably about late 2020. As we said, we initially started off looking at long-term rental strategies, and pursuit of what we hoped to get was real estate professional status. That's where a lot of the tax benefits, as you'll again learn about here shortly, occur, and when we're kind of trying to tap into that. But the STR option And the bonus depreciation currently tied to STR rentals is something that we learned about late 2020, and that's when we started to pivot our focus for 2021 in acquiring our STRs.
Yeah, they were not my client then. Otherwise, I would have told them earlier. So this is the IS definition. I like to go to the is.gov, So it was actually from the 2017 tax reform. And the reason the government had this bonus depreciation is really to incentivize investors or entrepreneurs to invest in machinery or equipment, not just real estate. If you read this, it's basically saying any assets that have a less than 20-year recovery period, depreciable years, can be bonus depreciated 100%. All the way it ended in 2022 for 100%, right? That was the end of last year. You purchased how many property in those 3 years? 7, right? So all in 7 enjoyed 100% bonus depreciation. So from 2023 on, it's gonna sunset. So this year's 80, then 60, and it will end in 2026. So this is it's not just for real estate people. It's for, let's say I have a factory and I bought equipment and the recovery period is less than 20 years, then I can just write off the first year. So it is really a way, Uncle Sam, to encourage you to invest in business, right? And this is done. Let's talk about the next one. So what is really the benefits of bonus depreciation for real estate investors? Here's a little slide we did. So everyone knows, right? And the regular depreciation is what? 27 and a half or 39 years. Do you know what is your depreciable years for your STRs? I'm quizzing you.
Well, I would say anything under 20, we're going to depreciate it.
I know, but if you go with the regular depreciation, short-term rental is actually at 39 years.
Okay. Yep.
Yeah, most people don't know. They think it's also 27.5 years because it's a residential. But whenever you do the short-term rental, like Andy gave you guys the best definition, is average stay is less than 7 days. You have to keep it that way to be a short-term rental. And that is considered a commercial property. So it's 39 years. And then if we can do a cost segregation study, this is again a buzzword. Yeah, cost segregation studies is just cut your properties into different elements to make more components to be less than 20-year depreciable years. Then we're going to accelerate the depreciation and take the whole thing as the first year depreciation, which the next slide is an example from one of Andy's property. I didn't want to put the address and everything on there for safety reasons. No, that's a real property, right? Andy, do you recognize this one?
I mean,
it's one of your Florida.
I remember
property.
Seeing these on the cost segregation studies now.
Yeah. I actually,
the property.
I extract this from Andy, one of Andy's properties cost segregation studies. So if you guys look at it, there's land is 20% of it, right? And then the 5-year is 30% of it, and the 27.5 years, 50 years. So if we don't do this study, the whole 80% will be depreciated over 39 years. Now, only 50% is depreciated over 39 years. That 30%, and I believe the cost is about $1 million. So 30% means 300,000, guys. So basically, on Andy's tax return, we can write off 300,000 because it is less than 20-year recovery period. That's what cost segregation does for you. Maybe Andy can give us even more insight into cost segregation study, how it's going to help you.
Yeah, this is kind of like the wow factor. And, I don't think it became real for Githika and I, even though we were well, informed on this strategy, and we started to pursue this strategy. And then, with our taxes, we took advantage of this strategy. And I think it came real once we got our tax refund check deposited in our account. And,
you didn't believe it, right?
In our child like behavior, we started jumping up and down in the bed because it was manifest. It finally came, and it was, quite frankly, the largest tax return not only that we've ever had, but we have ever heard of. and it's just following the tax code. So, I kind of reflect on this tax strategy is something akin to what maybe some of you have heard is called the BRRRR strategy: buy, renovate, rent, and refinance. And that's a way of acquiring properties to basically turn them over, use the equity that pull the equity out, and then you're able to kind of carry that forward in a daisy chain method to buy another property, right? Because you're going to increase the value, get it rented and cash flowing, refinance it, pull that equity out, and then take that equity and go buy another property. Well, a similar strategy can be had with the bonus depreciation. Really, you're doing the very similar things. You're buying a property, you're putting it into service, you're putting the material participation hours in, which is a qualification for the taxes. You have to get 500 hours of material participation within the calendar year. It's rented less than 7 days. And then once that's put into service and you have rented it out at least a few instances before the end of the year, you're able and conduct the cost segregation study. You're able to get your taxes back from not only the passive income that you would have generated from this property, but also on your W-2 incomes. And so all of that loss, discounts what you would have made through the passive income on the property, as well as if you're a W-2 earner, what you're going to have to pay in your taxes on your W-2.
Yeah.
All of that comes back in one big check, and then therein lies the opportunity to then go take that to another property and continue doing it. And that's how we've had this kind of self-perpetuating process that's kept us moving forward. And so we've not only, taking, what available cash we have, but also, it's Uncle Sam supporting our business.
I love the way you put it. Uncle Sam is finally has a good face.
Yes, indeed.
Here comes how you use the tax strategy to help you really accelerate your real estate journey, right? If you do the regular way, like you said, BR, what did you say?
BRR.
Okay, BRR.
Renovate, rent, refinance. So BRRR. 3 R's.
Okay,
sorry.
Yeah. But you made it much faster. The reason being, I also asked for Andy's permission. So look at this property. They were able to write off $300,000 accelerated depreciation. And then they have a couple of them. So they end up almost a zero taxable income. And through 100% legitimate measures, that the measures were introduced by the government to incentivize you to do exactly that. So that's not even a tax loophole. It's a tax incentive. They want you to do this. So in a way, if you don't do it, okay, you don't have to do it, but it's right there for you, right? Yeah, and also they not only got all their W-2 withholdings back, the big fat check in 6 figures, they also, for the first time in their life, got a child tax credit, guys. They were never qualified for child tax credit, but they got a full amount, right? That was a nice surprise, right, Andy?
Absolutely. All of this is just a big windfall.
And also the thing is, they didn't take that big 6-figure check to go to Vegas, right?
Nope.
They continue purchase more properties. That's the whole cycle. Yes.
Everything gets reinvested right back into real estate. Honestly, because of the advantages of this, we have had many discussions where we've maybe wanted to do other things, as far as investment opportunities, but we simply, while this is in play, we simply cannot rationalize any other strategy that would be as much of a windfall as this current one. While bonus depreciation is still active, this is clearly the best manner in which we can continue to build our wealth for our strategy to come to fruition.
So you plan to acquire the next 7 or 8 properties before bonus depreciation phase out, right?
Yes. So we're so far on an average of about 2.5 properties a year. Some years, a few more of that, less. Next year, we're looking to not only try to acquire up to 2 additional properties, but we're also going to be looking at opportunities to maybe turn over our existing inventory, because once the bonus depreciation is done on a property that you've acquired, if you were to sell that property, carry forward that equity into a 1031 exchange and buy another investment, then you can again do the bonus depreciation on that property as per the bonus depreciation rules for that year. So as June said, this next year it's 80%, or 2023 it's 80%, 2024 it will be 60%. And so the opportunity for maybe for us to turn some of our inventory, if we want to look at different markets, shift, there's more opportunities to kind of do more bonus depreciation while not having it solely be relied upon by the acquisition of new property, so building our portfolio, but rather turning some of it over as well.
Yeah, that's a really good point, Andy. So because 1031 is another great strategy that we touched upon in our first webinar, and we're going to have one in-depth discussion. Exactly, 1031 will allow you to go to much bigger properties, or from one property you can go to 4 properties. That's how you're just trying to build your depreciable assets, right? Mm-hmm. So even if this year is 80%, if the amount, your asset is bigger, 80% is still might be bigger than 100% of a smaller number, right, Andy?
Absolutely.
That's the whole point. Yeah.
Yep, absolutely.
Yeah, and that's all together. Otherwise, if you sell now, you're going to recapture all those bonus depreciation. That would be all your efforts just gone.
Yep.
Right? So it's a plan. It's a system, right? Yeah.
Absolutely.
So yeah, we've gone through this. So Andy and Nikki's tax liability was almost zero for last 2 years. It's a beautiful thing, and hopefully it's going to be zero for the next 2 or 3 years. And then it's a different story. You will be at a different place.
Absolutely. Yeah. That's the goal. Our goal is to acquire 15 properties, which we believe will sustain our passive cash flow, and that is in line with our the next 4 years ahead. So 8 more properties over 4 years. Yeah. And I do see one comment in the chat.
Okay.
Lily Lou. I don't know if you want to take those now or later.
We normally take it at the end. We try to finish our meeting in 30 minutes and Q&A. Okay. Perfect. Yeah, Lily is a dear client of mine. Yeah. Anyway, so I want to have a little bit of academic discussion right here. So everything we talk about until now is because Andy and Nikki was able to do self-managed short-term rental. So STR here is short-term rental, okay? That makes their activity considered as an active adventure instead of a passive investment, right? And actually it's active, right, Andy? There's a lot of work.
Yeah, don't get me wrong. You can't look at this as with rose-colored glasses. This is something that we know a lot of people who do this. This has been something that's been tremendous for my wife and I, as something that we have done together. We've developed our passion, and we really and thoroughly enjoy it. But it requires a significant amount of work. I would say, with the right network of people, you can get tapped into the systems that help you sustain in your direct management of your STR portfolio. Even though we could, after we bonus depreciate, we could, turn some of our properties over to a property manager. But after being able to, get systems and software set up, we're really sustaining very well without a great deal of workload in the long-term management of, as guests come and go, and, the toilet breaks in our property. And, we work with our teams to address these things. And by teams, I mean our handymen, our cleaners, our other people who are on the ground, because our portfolios are all over our real estate portfolio is spread across the United States. So it certainly isn't feasible for me to actually go and take care of a broken toilet, but I have a team that's ready on the ground to take care of that. I'm just the coordinator. I reach out to them, I get them on the phone and have them go over there as quickly as possible. Yeah. So I would say, overall management is sustainable. It does take work. You will, I think, come to empathize and appreciate those who have to work in customer service a lot more than you had prior to, because I too am now, messaging people with smiley faces and hearts, and, I'm welcoming guests and trying to, turn on my customer service, because you're always gunning for that 5-star review. The other part that I'd say is probably the most demanding in this strategy is the initial acquisition and setup for your Airbnb. It takes time to find a place, to research markets, to understand what your potential return is, and whether or not that's going to mesh well with the prices that you're set up to pay, and the ongoing expenses as far as interest rates and other costs that might be associated with that.
Yeah.
And then also the initial part of your investment to actually install furniture, all the little things that you need to set that up. That is a significant part of your workload.
Yeah, you know, the Uncle Sam didn't just put this code as active just for fun. It is actually, it is actually active. So if you heard me, 2 requirements. One has to be less than 7 days. One, you have to manage it yourself. You have to materially participate in this activity. So Andy gave us a really good example how he really manages this whole project. He does not have to manage the toilet, but he will have to manage the people who will go fix that toilet, right? So yeah, so it's not for the faint-hearted. It may not be for you. I always say don't do anything just for the tax, but look like Andy and Nikki loves what they're doing, right? You guys love what you're doing. So you have passion and you learn, you get better at it, right? Some people may not, but if you do love this, please take advantage of this tax code, and do not cry saying, I just found out today, it's already phasing out. Like I said, 80% is that better than nothing, right?
Absolutely.
80% probably no, Andy. 80% can't. Today's already December 15th. I don't think December 20th.
Hey, for the really aggressive, you might be able to fit it in, but yeah, and all that setup time, it goes towards your hours of participation for that property. So your material participation and setting that property up, you're going to knock it out just by setting up that property, going through that process, and then managing it. So
I have a great story to tell here. I have someone's gonna make it. You know how he is purchasing a short-term rental from his sister.
Ah, right.
So he's gonna have a huge bonus depreciation this year. And his question is, my sister already did bonus depreciation. Can I do it again?
On the same property? Yes, you can, because you're a new owner.
They don't go by property, they go by the taxpayer, right? And also the key word has to be placed in service this year. So as long, and the property already being placed in service, as long as the contract is signed, the ownership is over, right? And then another beautiful thing is when a sister selling to a brother, they can do what? Contract sale, installment sale. So the sister doesn't have to pay the recapture. Oh no, yes, the recapture, yes, but at least the capital gain doesn't have to be one tax bill. So that's called a creative financing and creative real estate purchasing, and get the year-end depreciation in.
I want to do one more thing, because my father was in real estate for over 40 years, and he didn't do STR rentals, but he was a real estate broker, appraiser, owned him.
That's in your blood, now I know.
And so he was definitely my person that I aspired to follow suit, because I saw the power of real estate through his many years of engaging with it. And one thing he always said to me that stuck with me and stuck with both Githiga and I as we started on our journey. He says, you can invest money in the stock market, you can invest in random companies or things like that, and you might get an outstanding return. But there's one thing about real estate that you can't get with any other investment. You can go visit and enjoy it. And so that's something that has a return that you can't necessarily calculate, but you can enjoy. And so I personally, we don't have all our decisions about where we acquire properties completely guided about where we like to go vacation, but it does play a small part, because when we go to those areas to look at houses, we see the market, we see the demand for Airbnbs, et cetera, and all of a sudden, hey, I love hiking in the Smoky Mountains, or I love going to Lake Superior, or visiting Denver. All of these are added benefits for whenever I go visit, and then I get to go, do my thing, hike or eat at restaurants.
You know what? That's a really, really good point. We actually will have one STR deep dive, and I am going to invite one of my clients. Okay, the joke is this: his property has the highest return of all the returns I did last year. and he did just what you said. It's a place like everyone wants to be, right? Yep. That's the point. So the second point I want to say is, I think Andy mentioned in the beginning of their real estate journey, they wanted to become a real estate professional, right? So that would be another webinar. We talk about that. So basically, real estate professional means that's really real estate is all you do. In your case, though, very hard, right? Because you both have a full-time job, And it's really like an audit risk. If you have both have W-2s and you claim real estate professional, that's going to really push you over. Basically, ask Uncle Sam, come and audit me. It's okay, you get audited, but don't do that, right? That's a little bit silly. So for people who have W-2 jobs, like both have W-2 jobs, that's a very difficult position to take. But for the ones out there, that the joke we have is a physician and a real estate professional, if they get married, it's a marriage made in heaven in tax.
You know because,
it. Yeah, one can exactly bring in the income on the paper W-2. The other one is going to bring the money in the pocket, but losses on the paper to offset that W-2, right? That would be another tax strategy. So before we end this, I still want to talk about the long-term rental, like what Andy's dad did. We cannot say, oh, because of all these beautiful things, the short-term rental, real estate professional, bonus depreciation, all those beautiful things, does that mean if a long-term rental just don't make any sense anymore? I personally don't believe it. There are a lot of other strategies you can use with your passive losses. So I want to specify here, like the $300,000 bonus depreciation Andy was able to take on the Florida property. If it's not a short-term rental, if it's a long-term rental, it will not be able to flow through to offset their high W-2 income. So it's not going to help them this year, right? But it's also in the long run, what I say is you have cash flow in your pocket that you never pay tax. Is there any other income that you make and you don't pay tax? No. Right? The second thing is that passive loss can be accumulated forever. There's no time limit. The last thing I want to talk about, there are other creative strategies to absorb the loss. One of them is a very common one, is you create passive income to offset these passive paper loss. How? You can invest in my restaurant. I'm kidding, I don't have a restaurant. But if I have a restaurant, it's going to be called Justine's Diner, right? And you can invest to be a 20% shareholder. And if I net $1 million, you're going to get $200,000 passive income. That's 100% passive, because Andy never even come into my restaurant. I'm the one who's doing the busboy and cooking and all the good stuff, right? So it's passive income for Andy. So Andy can use that. So you can get other beautiful cash flows without pay tax. So that's also possible. Okay, the tax codes are quite complicated. There's a lot of things. So I want to just go back and re-emphasize that bonus depreciation, cost segregation, real estate investment, no matter short-term, long-term, they're all good. It's depending on who you are. If you love real estate, go do the short-term rental. Go become a real estate professional. Go quit your job, right, Andy? And be a real estate professional. But if that's really not your cup of tea, you like to be like Andy's father, right? Just do slow, build up your wealth, and you can do other things. And there's other passive income you can create, right? And another beautiful thing is if you have a lot of passive losses, when you sell one of the property, the capital gain can be offset with all those losses. So you don't have to do a 1031. I mean, you sure you can, but if you don't have any tax, why would you do a 1031, right? So all I'm saying is there are so many creative strategies. Again, I'm your accountant. Talk to me before you do anything. Don't just go do it. In case there are some loopholes there that we can use, right? I think we're almost coming to the end. We'll control that 30 minutes, Andy.
Good job. Good job.
I think I do want to ask a little bit about your exit strategy. Right? So what is your financial freedom look like to me? Paint that picture for all of us. I would like.
Yeah, that would be a beautiful day. So, you may have heard my initial title, Commander. I am active duty. So my retirement from my government work will be in 4 years. And so that is tied to, that's kind of the time frame that both Githika and I have decided to utilize. That remaining 4 years to build our portfolio to the level where we know our passive income is going to essentially offset what we would have otherwise earned in our W-2s. So our 4-year strategy, get to 15 properties and then switch to financial freedom. Maybe work some days if we want to, but then it's really focused on us and what we want to do. We also want to get engaged with NGO work, in supporting and developing schools in my wife's hometown in northern India. So that's a passion of ours. and then do the other things that we're passionate about: travel, eating, spending time with our children. All of these things are going to be the windfall of what we hope is a successful endeavor that's proving to be very successful so far. And I guess
you can also be a good coach, Andy. I can tell.
Yeah, absolutely, absolutely. I'm always happy to answer questions, so feel free to always reach out. I'm happy. Both Githika and I are always happy to talk about this stuff because we really do enjoy it. Yeah, and I think that's the goal in mind. If all of a sudden interest rates drop, in the next couple of years, it's more opportunity for us to recoup and reduce our expenses and improve our bottom line across the board with any properties that we've acquired over the last year and a half and maybe next year as well. So, so far, so good. That's all I can say.
That's such a beautiful picture, Andy. Send us pictures.
I definitely will.
Yeah, there's one last thing I want to mention is there's talks in Congress now to resume bonus depreciation. Are you happy, Andy? But you will be done in 4 years, I think.
I will certainly welcome that news whenever it decides to come.
Yeah. You guys can see on the screen if you have questions. Everyone knows me. We also have a real estate arm. So Sushil is information on there. I think, Christy, you should also pop up some of those 15-minute link for people to schedule. So Sushil we are very, very, we are the expert for Chicago multifamily, but doesn't mean you got to buy that. I think it's a good thing that you talk to Sushil to understand wherever your journey is at. So I think without further ado, these are some of the social media scan code. I do have a blog you guys can watch. I have some Chinese webinars. If you speak Chinese, you can listen to. Pretty much it. Let's go to Q&A. Christy, are you going to pop up the question or do I have to look? Oh, great. Okay. Very good question. I think Andy has his answer. I will expand on your answer, Andy.
500 hours over the course of the calendar year for that specific property. The great part is if you're married, both of your work contributes cumulatively to that end. And that allows you to, meet that 500 hours. 500 hours seems like a lot, but once you're down on the ground, especially in the initial setup, you'll have like a crazy week where you're going to be pulling 12-hour days and then, some other things before and after. So really, that goal is very, very doable, especially once you add in the ongoing management, things that you need to do just to sustain the property and manage guests that are staying there.
Great. So now I'm going to be wearing my tax nerd hat.
Please do.
Very good. You're so good. You're very thorough, Andy. So it's actually a little bit, how do I put it? Material participation. If you go to the IS publication, there are 7 ways to make it. One of them is what Andy said. And Andy said it very eloquently. Everything is covered in that one. So there are 7 of them. There is one I love to tell people is this one. If you spend more than 100 hours in this activity and nobody else spend more time than you, that's also material participation. So that's a little bit less requirement than Andy's. They all called. So material participation is beautiful. It's 7 different things, 7 different ways. People say, why is it so complicated? It's really, in essence, you don't have another one to completely manage for you. You just collect the money. So you have to spend time and to really manage this, okay? So that's another question that you can always talk to me. But I don't know, Andy, do you guys use a tracker for your time?
Yes, absolutely.
Maybe you can, give people some suggestion on the tracker.
I have to pull up the app. But yeah, we use a time tracker for our app. Let me just quick see if I can get the name of it.
Yeah, the tracker is very important because
working hours.
Working hours
is one that we use.
Yeah.
We'll basically go in and start to just add in the hours that we have. Honestly, a lot of the hours that we do spend on a property, like the small things like, helping manage a guest or stuff like that, we aren't all that proficient at making sure those micro minutes are always added in, because honestly, when we're visiting the properties and we're doing that setup and we're doing all of that, that is such a wealth of time and investment on your side that essentially covers the entire litmus test that you would otherwise have to prove for that property.
Very,
But
very good.
please definitely keep track your hours.
So look, Andy just said he got those 6-figure checks. He's like, is this for real? Am I going to get audited? That's a lot of my physician clients ask me, am I going to get audited? I think you don't have to sit there and think about that. You just keep good records. So if they do knock on your door, hey, I have it, right? So do not having any records and just claim all these things. Then one day you're going to be in trouble, right? And I'm not trying to scare everyone. We just had a lot of continuing education as an accountant. So basically, the IS finally got a lot of funding from the tax reform that Biden passed last year. So they pretty much doubled their field agents, okay? So we will have more audit, but I'm not going to worry because we have good record keeping. Mm-hmm. So because this is the tax code they wrote. We didn't invent it, right?
That's right. Keep your records, put them together. Otherwise, we're following the tax rules as they've been defined, and we keep our receipts, we keep our records, and I mean, no one ever hopes to get audited. I'm certainly not asking for it, but if the call ever comes, it will be okay.
Yeah, and you're not going to not do this just because it might be audited. That would be silly.
Yes, agreed.
Okay, next question. Good question.
To take the bonus depreciation, can you just rent, refinance, and sell? So you have to acquire a property. So let's say I want to go to Asheville, North Carolina. I will first off, you have to make sure that you do your due diligence in looking at the market that you are investing in. You do not want to get hung up on local regulations, HOA rules, all of a sudden acquire a property that you can't short-term rental. So first off, you have to make sure that you're taking your time to invest in a market that STRs are well established, especially in markets where local ordinances already are pulling taxes from STRs. And so there's a benefit for states and locals to keep STR rules flexible for investors to come in, and then they get the windfall of the taxes that's coming in. So first off, find a property. So if you're going to look at like Asheville, North Carolina, and buy a property, you'll buy it, go through the process, and then start to set it up, and then you start renting it. And the key, again, is get that 7-day or average less within that calendar year. So let's say I buy it in October and I end up having 15 guests, and my average rental period is 5 days, which would otherwise be kind of a normal rental period, especially for that market. So I bought it, I set it up, I rented it. Now, the whole kind of BRRRR strategy I was originally referencing is kind of an example of what we're doing with our taxes. You have to look at the right opportunity when you want to refinance. One, you have to, if your market is shooting through the roof and all of a sudden your equity has gone up even within the span of a month, maybe it might be worth refinancing, but probably not at least for a year or two, especially given mortgage interest rates and where they're at. But the opportunity to refinance once interest rates go down, really reduce your expenses. And then, you wouldn't want to necessarily refinance and sell because those would be two counterproductive strategies. So our strategy is for our STRs, buy, hold, get the cash flow, utilize that cash flow to reinvest in our properties, continue propagating and expanding our portfolio. When and where, we have gained a lot of equity in the properties that we have acquired. We have not refinanced any of them because, one, interest rates have continued to go up. I want to get them going down. So get me when they're at 1, 2, 3, 4%, and we'll be good to refinance. And even then, maybe I would want to pull equity out if I'm in, seeking to expand my portfolio more. But maybe I don't refinance or I don't do anything until we achieved our goal at 15 properties, and then we might just refinance, not pull any equity out, just reduce expenses, and then you have even more cash flow coming in. So it's a balancing act between your cash flow coming in, expenses going out, and if you can all of a sudden drop your interest rates, you're going to have, save all that expense, and it's going to go right back into your bank account. And then, upon your opportunity to, exit out, you want to sell everything and go buy a huge apartment building, that would be the opportunity to sell and, do the 1031.
Thank you, Andy. So I want to chime in a little bit on Lily's question. I know Lily's a very happy retiree in Florida. beautiful place you just purchased, right? So the only thing I want to say is when you sell, really try to do a 1031. Don't pay the Uncle Sam the capital gain. A lot of people say it's too stressful. I don't want to do it. There are ways that are not stressful. Like you can go into DSTs, you can go to passive investment that, and then later on you can give it to your children with a step-up basis, Lily, I know you kind of want everything to be simple. I love it. I'm already also getting to a age that I want things to be simple. Simple does not mean you just give Uncle Sam and let Uncle Sam rob you. Yeah, next one.
So you maybe you can answer this, but I have had this conversation. So basically, a property that is put into service after, Justine jumping in with the date as far as bonus
2018, something in 2017, a month, September or something. Yeah. Mm-hmm.
So as soon as if you would have acquired a property and put it into service, and let's say initially you did it as a long-term rental, but now you're going to shift and do a short-term rental. From what I understand, and I guess Justine, check me on this, is if you did do a short-term rental, you could do a cost segregation and bonus depreciation back on the amount of the bonus depreciation of the year that you put it in service. So you bought it, and let's say if the rule started in 2017, you bought it, put it into service, long-term rental 2018, and just now you're deciding that you want to do an STR on it. And let's say for 2024, you put it into service as an STR, you hit all the litmus tests of material participation and everything else, then you do the cost segregation. My understanding is that you would be able to 100% bonus depreciate that based on the year you put it into service. But please correct me if I'm wrong.
You are pretty much correct. There are too many situations. In your situation, it's correct. But how about if this person has never done an STR, should he still do it? I would say if you had other passive income that you were paying tax for, you should, right, to rectify it. And if in those years you had some passive loss, but this year you want a big passive loss to offset a capital gain, you can still go back and do it. So pretty much you can do it, but is it gonna help you? That's the question. People always says, I have people coming, everyone does cost seg, but it may not help you. Again, it helped Andy, it may not help you. You understanding the tax code and talk to your accountant and to make sure this actually gonna help you. But if you bought it in 2015, no, right? You have to be bought them before that. And then we can also do catch-up depreciations, like the depreciation you didn't take before. But the one thing is you cannot catch up those depreciations in the years you did not do short-term rental, and now you're trying to write off all this year. No, you can't. But if you did short-term rental those years too, then you can. I don't know whether I'm making myself understood, because the IRS doesn't want you to take advantage of the code this year for the things you did before. So they basically said, if you did it in 2018, did you do STR? If you did STR, yes. If you didn't do STR, then you still only just accumulate the passive loss. So they go back to those years, but you can do an accounting method change form in the current year and catch up everything. Yes. Very good question. Next one. You will have less depreciation.
Yes, you'll have less depreciation,
yeah.
Which actually goes to the point of potentially looking at, other markets, turning over inventory, doing 1031s. Again, we have not turned any of our inventory because our properties were purchased in good cash flowing markets. So even though we're losing out on what was otherwise depreciation that we already fast forwarded on, we're going to get that with additional properties that we purchase as we expand our portfolio. But therein lies the opportunity of really looking at the market, making sure it's cash flowing.
Yeah, even if you look at the most conservative, I only bought one property and I accelerated all the depreciation this year. I ate all my food. I ate all my 1 week's lunch one day, right? And then next year I'm going to be in big trouble, right? So Andy said you have to reshuffle, you have to think through, you have to buy other properties to get more depreciation. But you can say, I just don't want to do any of those. But at least you save tax today, right? Is today's money worth more than tomorrow's money? Mm-hmm. Especially in the high inflation time, right? And the whole point is you keep building up the depreciation through all these different strategies. This is an active project you're managing. It's not a one-off deal.
Mm-hmm.
Yeah. Next question. Good question, though. If you are a real estate professional, doesn't matter short term or long term, everything to you is active. But if both W2, Robert, I think we discussed this, it's just very dangerous to claim that. Okay. But nobody said you cannot. And there are court cases that the IS actually approves. But I'll tell you, all the real estate professional cases the IS choose to audit, more than 90% were denied. And because they only pick the cases, not only, they mainly, because I don't know, I'm not IS, they only pick the one, they normally pick the ones that have 2 W2s, right? So you have to establish not only that you worked 750 hours in the field, you pretty much have to establish you worked more than 2,000, right? Because a regular job is 2,000 hours. That's very, very hard. And you cannot combine the couple's activity. Yeah.
Right.
From the material participation, you can combine the couple. That's a big difference, Robert. So you can take it. I'm just giving you all the warning.
Yeah. And honestly, that this is that for us in our strategy, given that we were both W2 earners and very engaged professionals in our other jobs, this is a kind of a real reason why we had to switch strategies, because we were not going to see the tax windfall through real estate professional status, given the fact that we were both W2 full-time professionals.
Go ahead. Next one. Oh, all these are really good questions, guys. You're so engaged. I love it. Why not? You just your portion. And also most of the commercial properties, you rent it to your entity, right? So you can depreciate the whole thing. So let's say I'm a doctor and I bought a whole complex. I'm only occupying one. I'm not going to be renting to me. I'm going to rent to my practice, right? So it's a 2 different entity. This should definitely be able to get the whole depreciation. Even if you take, let's say, Justine LLC owns this building and Justine CPA rents from Justine LLC, right? You can still take the depreciation because it's 2 different entities. Go ahead.
I struggled to show this.
It's up to you, Andy. No pressure. No pressure.
No, yeah, I'm happy to answer questions. Justine, I know you have my email. By all means.
We have your email. How about Chrissy? Just type in the chat box.
Well, I don't.
As long as Andy agrees.
Yeah, no, that's
I don't know privately. Let me see, but I don't even know who this person is. Actually, he shows up as a.
Okay, how about you? This person gets the 969. Email Justine, and I'll give you Andy's email address.
Yeah, I think that's the best.
He just doesn't want you to get 100 emails, Andy.
Exactly. Yeah, I don't want to show his email.
Thank you for being so generous.
I'm happy to answer questions. I know that this is a kind of a nebulous process and it's hard to kind of make sense of it all, but
okay,
I promise you it does make sense.
Okay, next one. This is question not very clear. So tenant improvement, if as a landlord you didn't make those tenant improvement, I don't think so. If you are the tenant who made the tenant improvement for your business, yes, you can actually depreciate it in your business return. I hope I made it clear. Whoever made the improvement, right? Oh, that's a good question, Andy, for you.
Yeah, no, it's all about getting the team together, right? So once you are kind of looking for your markets, you want to look at something that, is going to have hopefully a sustained year-round demand for your property. So the beach areas, the mountain areas, lake areas, depending on what part of the country you're going to, all these are typically active for guests who want to come stay. So once you're able to find that property, get it into service, and rent it out, you clearly aren't going to be able to. I mean, just for example, the closest property I have is downtown Miami, but I have others in Destin and Tennessee and Colorado. So it's all about getting your team together. I'd say, a number of handymen that would be available, services, getting contacts, so you can quickly roll down a list of trusted contacts that you can go to for fulfilling anything that comes up. The screen door came off, or the furnace isn't working. The other things, and just tips of the trade, Wi-Fi is the best thing that you can do. We manage 99% of our business through our phones. And both my wife and I are signed in on the same software management account. We have the same contacts. We create communal text threads. And so during our day, when things come up, we're able to quickly navigate those without having it be an undue hindrance on either one of our sides, because we're doing it together. But really, it depends on getting your team together. All those resources that you would need to address things that come up at your house. Your cleaners are going to be your eyes and ears on the ground that help you make sure that the house is maintained well. And honestly, your guests are really helpful. We send automatic emails. Our system does it automatically. And it's just like, hey, Frank, hope you're having a wonderful time at the property. Let us know if there's anything that's not perfect. And it's a great, way of, one, you're going to get 5 stars in communication, and 2, who's going to be more picky than the guest that's paying to be there? And they're going to tell you exactly what's going on. And I'm telling you, sometimes you're always going to get the 1 or 2 that come out and they're just going to, no matter what you do, you bend over backwards, they're always going to be upset. But I actually got an email the other week with this woman who just gushed about the property, loved everything, and then gave me a bulleted list of, hey, just in case you weren't aware, here's a bunch of things that you might want to look at, like one of the rods was loose or something like that. And so you have all these kind of a Swiss cheese method of being able to kind of take care of your property, understand what's going on, put ring cameras up, and link your Wi-Fi router to your phone so you can quickly look it up. So if a guest complains, hey, the internet's not up or not working, did they enter the wrong password, or do I need to call the internet provider? Well, I can quickly go look, is my ring camera on? Is the router on? All of this stuff you can set up on your phone, and it's just a part of finding efficient ways to manage your portfolio.
Okay, I think we have we can take a couple more, I think. Very good, Andy. Yeah, it's not easy. Yeah, but you get better at it, right? You get better at it.
Yes, yeah. You'll be surprised how quickly you do.
Yeah. And I think in a way, another thing is you really care about the people, and that shows even in your business, right? You care about, because that's what makes your short-term rental better.
I mean, we didn't go into Airbnb blindly. We were active guests on Airbnb everywhere we go. I mean, we have kids in tow. And so the fact that you can have your own kitchen and go to a grocery store, no matter where you're at. And, if you don't want to go out to eat for every meal, it's nice to have a refrigerator where you can do that for yourself. And so we love staying in Airbnbs, and we went into that kind of with that reflection. And we really want guests to have a wonderful time. It's not about the bottom line. It's about making sure that your properties are doing well, because that all translates to reviews and more guests and more money, and it all is connected.
Sure. I guess you can. I mean, this is supposedly is a selection that you make, and it's a perpetual selection, but you can always terminate it. Technically, you can. Yes.
Okay.
Next one, if we don't have any more, yes.
Yeah, and there's only just another one, like what are the good recommended cities for STR? I think that's it.
If we don't have any, we can close up. Thank you for your time. Do you have another one, Christy? You want to put it up?
Yeah, as I mentioned, like I'm trying to look for that one. I don't know where I put it. Someone is asking what are the cities, recommended cities for STR.
Yeah, I would say there's lots, and so I wouldn't want to nail you down to one. It really depends on. Here's what I'll say: use the tools available to you to do your research. AirDNA is a website that you can subscribe to, and it takes data from short-term rental websites like Airbnb, VRBO, and distills that down into a format that allows you as the potential investor to research your markets. So you can go in using there, if you have an inclination like you personally always go to, somewhere upstate New York, you can start punching in, towns into AirDNA with your subscription to understand, hey, this is how much the average home gets there. Or you can actually fine tune it. If you are all of a sudden looking at maybe putting an offer in on a property, you can dial it in as like a 4-bedroom, 3-bath, this many square feet. And then it's going to give you comparable properties, and it's going to show you what how they performed over a period of time, their occupancy rate, their gross revenue, and what the AirDNA suggests that they could actually get in revenue, because sometimes people just do part-time rentals, and so you won't see the maximum extent. So I would go on a couple things. Use the research that's available to you, the tools to help make sure that you're making an informed decision. 2, make sure it's a place that you actually like to go to, because you will have to go to it. You will have to spend time. So that's the added benefit part. The third part, make sure you do your due diligence in knowing how the community, that state, and that city apply local regulations to the STRs in that market. Because if all of a sudden, you buy something and then later on they end up putting rules in that restrict your access, then you're going to be in trouble. So the best areas to look at are markets that already have rules established that are giving the government revenue and make it almost impossible for them to ever kind of reverse course on STRs, because you've heard stories about people, neighbors, and they didn't like STRs or something like this, and that led to a HOA rule or a community rule. If this is done in a place where they already have it established, you're good to go, and on much more sure footing. So those would be my kind of recommendations.
I'm going to echo that one. I have one client of mine had a beautiful Airbnb and profitable, very profitable. And then the neighbor called, and then the government come in, and they will fine almost $1,000 a day.
Yep.
Yeah. So, they're going to fight it, but you don't want to get into that. Really don't want to get into
Not worth it. Not worth it.
Because it is a business, guys. It is an active business, right? Make sure the environment is good. So thank you again, Andy. This is even more interesting. I am listening to you, and I heard so many new things and learned so many new things from you. Thank you so much, Andy, for sharing your knowledge with my clients. And thank you for everyone who coming. Schedule call with Sushil if you are interested in real estate investment. And again, we have 8 more sessions of this coming. Normally once a month at the last week of the months, you will get our emails, and then the recordings will be sent to you. You can send to people that you think might be interested. And we are small business, and really count on everyone's referral. Thank you so much, and hope this is helpful.